My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little money. My job is not just to entertain, but to educate and to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. After a day where the market was pretty much on hold in anticipation of tomorrow's all-important non-farm payroll report, Dow gaining 79 points, S&P edging down 0.2%, Nasdaq declining 0.09%. We need to talk about the difference between the haves and the have-nots in this country. We've seen a series of earnings reports from a whole universe of retailers, and they're truly disconcerting. Because while everyone's feeling the pinch of inflation, the have-nots are feeling a heck of a lot more than the haves. This must be talked about because of the incredible implications it has for your portfolio and what happens next in the stock market. Like I've told you before, we can't just call out the consumer as so many people do. It's so lacking in rigor. You can't say the consumer's weak or the consumer's strong, even if that's what a retail CEO might tell you. See, most retailers, they don't know about the consumer. They know about their own consumer, their own customer, which is why the people who run these different chains can have such wildly different views on the situation. I want to start with Five Below. That's the fun chain that's filled with totally cheap, totally discretionary goods. Discretionary meaning Wall Street talk for you don't need it. This fine Philadelphia company had been growing like a very profitable weed, but now it has indeed hit a wall. Five Below is still putting up stores like mad, which I think, by the way, is a mistake until they figure out exactly what's going wrong at their existing locations. Last night, Five Below reported a quarter that went over like a lead balloon. I mean, it was truly a terrible number. Very weak same-store sales. Outlook that forced analysts to slash their estimates. And that's why the stock tumbled 10.6% today. What went wrong? All right, I want you to listen to this from CEO Joel Anderson because it is quite sobering and he's quite smart. Quote, this quarter solidified that consumers are feeling the impact of multiple years of inflation across many key categories such as food, fuel, and rent, and are therefore more deliberate with their discretionary dollars, end quote. And then he goes on to say, quote, the slowdown we experienced was across all geographies, further suggesting there was a broader macro impact, end quote. Look, and I was devastated with that, but he's not alone. Yesterday, we heard something similar from Rick Drelling. Now, he is the CEO of Dollar Tree, 16,000 stores. He explained, quote, this was the first discretionary comp decline we've seen at Dollar Tree since the first quarter of 2020 at the outset of the pandemic. Dollar Tree's quarter one comp came in below expectations because Easter was especially challenging for us this year. Easter, he said? Yes, Easter is a major driver of discretionary demand during this period. Apparently, it's 10 times more important to Dollar Tree than it is to other retailers. How bad was it this time? In Drelling's words, and I quote, recent consumer research showed that Easter gatherings were down 20% this year, and that 6 million fewer American households purchased Easter products in 2024. That's not good. That's not good at all. Now, there's just one problem with this analysis. There's a whole other cohort of consumers in this country that probably didn't even realize that Easter was tough for a huge part of our country. That cohort includes the 74.5 million households with a Costco membership. It's only $60 for the basic card because these people can save a huge amount on groceries and discretionary goods. Costco carries a small number of products in bulk, which allows them to drive a hard bargain with their suppliers. This company just beats them up, just clobbers them if they don't play ball. Hey, they can always leave. Or, yes, Costco can set up a premium brand called the Kirkland Signature, which goes directly against their product. I almost exclusively buy Kirkland myself because, in my opinion, it's almost always better, albeit less expensive, and I like the big sizes it comes in. But now let's think about who Costco is, all right? What is their consumer? Well, their consumer first needs a car to go to most of these stores. Not everybody can. Cars got out of reach for millions of people during the pandemic, and they haven't come down much. Second, you got to have the $60 up front to be a member, which for many people is a meaningful upfront expense. Third, you need a house or an apartment big enough to fit all Costco's bulk merchandise. This stuff is so huge, you don't have anywhere. Look, if you don't have a big enough place, you can't go to Costco. In short, it's not just the wealthier consumers have more money. They also have more opportunities to benefit from companies that are willing to fight against inflation, like Costco. And look, I'm not just talking about the legendary $1.50 hot dog. I'm talking about aisle after aisle of savings. Now, it's possible that the have-nots can go to Walmart, which is certainly a good bargain now that they've rolled back 7,000 items year over year. That's fantastic, but it doesn't take prices back to where they were in 2019. About the only places that offer those kinds of deals are the off-price chains, TJX, Ollie's. These companies get their merchandise from cash-strapped retailers that need to unload inventory so they can thrive when the rest of the industry struggles. I love my Ollie's. I bought a ton of books there for under $1 each because they've been water damaged. So what? They're no less readable. We're seeing this divide play out in all sorts of venues. We just don't talk about it. We don't want to see it, maybe. Big Mac fries, Diet Coke combo, too expensive. Let them make it at home. Pasta bowl from Olive Garden, too expensive. Go to Chili's, Texas Roadhouse, something cheaper. Hey, that's, by the way, that big smasher burger for under $11. Now, that is for real. And by the way, includes fries and soda, unlimited soda, actually, but not unlimited chips and salsa, too. Keep it cheaper than McDonald's. Now, just like the Easter retail divide, there's a considerable number of people in this country who are somewhat struggling. And then there are others who've been able to cash in on the stock market, which we know has been bountiful, get a huge amount of interest on their savings, which cushions the hit from inflation because the rates are so high. They can afford the real estate, gigantic percentage buy homes with cash, for heaven's sake. They can keep rent up because they have enough to pay up. Cars, not a problem. Yet shelter and cars are the major parts of the inflation issue that faces the Fed. I think the billionaires who come on our air, well, there's one yesterday, who wring their hands about the problems with commercial real estate, are truly insensitive to what's going on with regular people who will never be able to get a job on one of their properties. Every day we hear from strategists who call for several rate cuts because they want stocks higher. I want higher stock prices, too. But if we get multiple rate cuts and inflation comes roaring back, it's the have-nots who'll get hurt, the ones who had to skip out on Easter this year. That's why the stakes are so high for tomorrow. That's why the stakes are so high for the Fed. It can't afford to cut rates until there are more people out of work. But at the same time, it doesn't want to cause mass layoffs. Difficult position. Fortunately, the Fed cares about the people who can't take advantage of Costco, the ones who are struggling to keep their cars so they can go to work. These people have already moved back to their parents' homes. The gulf is wide. But let me tell you, the wealthy investor who doesn't know enough about the gulf, well, that person will be disappointed tomorrow if the employment report's too strong, because it means no rate cuts. But it also means that people can still find jobs. They just need to be protected from inflation. So let me give you the bottom line of a very complex story that directly hurts your portfolio if it goes wrong. Wall Street may be rooting for a weaker job market so the Fed can start cutting rates. But keep in mind what you're betting against when you throw up your hands in anger tomorrow at a sub 4% unemployment rate. Jay Powell isn't worried about those of us with big portfolios. He's worried about the tens of millions of people with almost nothing in the bank. Sorry, you come second. And all I ask is you be ready to take that back seat if the employment number's hot. Because slaying inflation, not promoting jobs, remains Powell's most important mission. And at this point, his most important legacy. Let's go to James in New York. James.
Booyah! Jimmy Chill! What's going on?
I'm feeling a little chill right now. Definitely. What's going on with you?
I just want to give a shout out to my beautiful fiance, Deborah.
Deborah's fat. I love Deborah. Love Deborah. Not that close.
Also, yeah. I want to honor and remember the greatest generation who stormed Normandy Beach 80 years ago today. They protected our freedom. I love them for it.
Absolutely. And I'm glad you bring that up. Thank you so much. Thank you.
I've been following you for 20 years. Excuse me, my voice is gone.
No problem.
And your wisdom and teaching has been amazing. The best advice I ever got from you was don't sell your winners, sell your losers.
Yes. Is it so hard? Is it so hard to hold on to Apple and Nvidia? No. I want to hold on to Bausch Health. I mean, come on.
It saved me so much money over the years, you know?
Thank you. Thank you for saying it. But this guy's filled with good stuff. Was that Denise who was the one I'm supposed to the shout out? The first.
I'm sorry?
The initial shout out. I'm joining the shout out. What's going on? Deborah. Okay. Deborah. I'm shouting out Deborah.
Deborah, my fiance. She's beautiful. She's gorgeous. Okay.
Hey, it's on the inside, partner.
Chill, master. I got a company that's a market cap $193 billion.
Okay.
I got net cash balance sheet, $367 billion. Forward PE, 9.5. Price to sales, 1.5. Price to book, 1.3. Analyst community, 47 buys, 0 sells.
All right.
Okay. You know what it is,
better
right?
let me in on this. No, I don't know what it is. There's a lot of companies describe that.
Come on. They just did a convertible for a convertible price of 106. Chill, master. Alibaba, unlike Nvidia.
Okay,
and Apple.
Alibaba is the only Chinese stock I like, but remember, you're in the crosshairs of the government there. That's something we have to engage the government. I'm not saying against that, but Alibaba is incredibly cheap. My friend Dave Tepper, I'm actually proud to call my friend, who owns the Panthers. He and I both think this is the cheapest stock in the universe. But if the government doesn't want it to appreciate, well, then they just won't let it. And thank you, Deborah. Thank you to all the nice things you said. The Gym Master thanks you. And your voice, maybe you work on that during your day job. All right, listen to me. The street might be rooting for a weaker job market so the Fed can start cutting rates. But keep in mind what you're betting against if unemployment stays below 4%. Mad Money tonight. At Lyft held its first ever investor day, what does the company have planned to help it cruise into the future? I'm sitting down with the man in the driver's seat on the tail of today's event. Then Campbell's earnings crossed the tape yesterday. I got the CEO fresh off the report to get a better read on what the numbers are really saying. And later, I'm checking in on Chubb after investor legend Warren Buffett announced he bought 6% of this company. Do not miss my exclusive with Chubb. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
There's not like a great turnaround story, is there? A little over a year ago, Lyft, then the struggling rideshare company, that's how I identified it, brought in David Risher as its new CEO, and he's made enormous strides both in improving the platform and bolstering profitability. That said, a lot of this was low-hanging fruit, and many investors still wondered if there was a reason to own Lyft for the long run rather than just sticking with Uber. Today, though, Lyft held its first ever investor day here in New York City. They told a pretty darn bullish story with some impressive long-term financial targets. They're projecting that bookings can rise at 15% compound annual growth rate through the next 3.5 years. Hey, by the way, throw in margin improvement that could lead to some juicy profits down the road. Lyft shares initially jumped in response to these targets and were up more than 11% at their highs of the day. Then they gave up most of these gains, ending up the day less than 1%. Hey, that sounds like an opportunity to me. Let's check in with David Risher to get a better read on the comeback story. Mr. Risher, welcome back to Mad Money.
So good to be here, Jim.
Okay, 15 months,
yeah.
And what a change, a series of changes, everything from faster ETAs, lower prime time, conversion, these are all going in your direction.
They are. Well, we're actually driving them in the right direction. That's what's really happening. It's not just happening.
No, it's not.
We wake up every morning and say, how can we do better for our riders and drivers? And that's the magic. If you do well by them, the company does well.
Okay, my first question was actually asked, how do you divide the time? Because if you get happy drivers a lot, there's a very virtuous circle.
Yep.
And that it almost starts with the drivers before you get to the customers.
You know what? It really goes like this. It goes like this. So, for example, we have more drivers now on the platform than we've had in the company's history. Driver hours is an all-time high. So that's interesting, right? Because also low unemployment rate, that says they're liking what they're seeing. They got a lot of other options. And you're absolutely right. When that happens, pickup times get faster, pricing gets good, riders take it, and then rides beget rides. And so that drives more drivers onto the platform. So as long as we can keep doing this, and I think we can do it for a long, long, long time, we got a great business.
Well, you also have things that you come up with things.
Yeah.
Like this commuter lock-in. I thought that was brilliant.
Thank you.
Tell me, no, this is like last time it was the woman driver. This
Right.
commuter lock-in, this makes a ton of sense.
Yeah. So the way we think about it is the first thing you got to do is you got to get the foundational stuff right.
Right.
Once you get that right, you can really start to innovate on top of that. You mentioned Women Plus Connect. We love it. So do the women riders and drivers. We have a 70% earnings guarantee for drivers. They love it. That's fantastic as well. And then the newest thing, which we're just in the early days of rolling out, is a price lock that allows you for the same trip every single day. You know, the daily commute sort of thing, but you don't like the price moving around. This allows you to pay a simple fee, probably about $3. We're still testing it out, $2.99, and the price will be locked in for a month for the segment. And it'll make it easier for you to commute.
Fantastic.
Yeah,
now,
thank you.
I get off the plane about 2 months ago with my wife, and I said, look, Lyft's got this deal. They're going to be right there. And she goes, no, they can't do that. Let's just use Uber. I said, no, but get this Risher. She goes, don't buy it. It doesn't happen. In truth, not only does it happen, but how many times have you really missed the on time?
Very rarely. I actually took it the other day. I'm so pleased. So I know all the stats. You know, we get millions of rides. I think we're down to like 1.5. So what you're talking about, just to be clear for everyone who doesn't follow us like you do, which I appreciate, is that if we are more than 10 minutes late for a scheduled ride to the airport, we will literally pay you $100. So to be clear, we don't want to pay you $100. Right. We want to pick you up on time so that you can get to the airport on time. Last I checked, I think we were down to 1.5% remediation rate. It basically, but this is all about what we call operational excellence, just doing it so well that as soon as you finish that ride, you're like, of course I'm going to. Your wife is finally going to take Lyft by default.
Well, that's what's going to happen.
Yeah.
That's what's going to happen. Now, new things that you were talking about since I've seen you. growth partnerships make a ton of sense.
Yep.
Lyft Media Platform with the tablet make a ton of sense. Profitable. Tell me how it's going.
Sure. So a couple of different things you just mentioned. I think that the Lyft Media business is really interesting and one that a lot of people don't know about because we're still early in the process. Look, every single day, brands want to talk to their customers in new ways. We've got partnerships with brands, big brands. Chase is a brand, a huge company. NBC Universal, we've been working with them. Delta has millions of SkyMile, passionate SkyMile users. They can actually earn points on the Lyft platform. So little by little, what we're trying to do is create integrated partnerships that allow these third parties to talk in new ways to their customers to create a bigger experience.
Okay. Now, is it time to start thinking international? Beyond Canada?
Yeah, well, so let's talk about Canada for a second, because even 6 months ago, we were barely focused on Canada. Over the last 6 months, we've really started to focus on it, bring that customer obsession, bring that operational excellence. Our share in the Toronto area, for example, just to start, has doubled, literally doubled over the last 6 months. So what does that tell you? It tells you that this same customer-obsessed approach, maybe it can work outside of the U.S. Certainly it can work in Canada, maybe someday. It's not our near-term focus, and we didn't actually bake it into our plan, but it gives us a lot of confidence.
Now, do you have any surveys that tell you who was using, say, 90% Uber, who's down to 60% versus Lyft, 40 Lyft, 60 Uber? How is that in terms of trying to, what's the trend line there?
I mean, so because what we can tell you is because we've grown quarter after quarter, this is now the 5th straight quarter in a row, we're clearly doing something right. And that's my whole thing. I mean, I understand you bring up the other guys. I forget who their name is, honestly. I think you just said it. I don't remember. But what I think about is
I have
competing.
short-term memory lapse.
Yeah, me too. But I don't so much think about competing against them. I compete against the 160 billion rides that people are taking in their own cars every year. Or, and here's an even bigger thing, I compete against staying at home. We want to compete against your couch someday. I don't want you staying home. I want you out and about. As we were talking about before, that's where all the magic happens. That's the real competition.
All right, now how about magic of autonomous? Just out there, not something you need to think about yet. But, just being able to use these as these machines, as I know that Jensen Huang wants to call them, machines.
Right, yeah, they are machines, mechanical drivers, right? Yeah, look, they are going to come onto the platform someday. Here's what's going to happen. Right now, if you're in San Francisco, you see them around. It's still pretty niche compared to, we do 2 million rides a day. That's a pretty big number compared to what they're doing. But at the same time, over time, we think we're going to be able to welcome them onto our platform, and it's going to expand the pie for everybody. I'll tell you what, sometimes drivers look at me and they say, what, I don't worry about those things. By the time they get to be big, I'm going to be long gone. I'm going to be doing something else, and it's going to end up being a hybrid model of some drivers and some autonomous cars. But I think we're talking years.
And then finally, for this Analyst Day, what the team, how's everybody feeling? Because 15 months, I mean, when you came in, there were a lot of people who doubted you.
There were, including, frankly, I think some people at the company who had gone through a rough time. Look, this has been so great. And I would say this I'm a new CEO, right? So what do I really know? But I can tell you that bringing the team together, having them work through this thing together, having us figuring out our long-term targets, how we're going to work together to kind of get up all on stage and pass the mic back and forth, silly things to big things, so clarifying. And it just unleashes so much energy from your team. If I were giving advice, I'd say, do schedule one for 6 months from now just to get your team focused on it.
I think that's absolutely right. And you've done a remarkable job. And we'll talk next time about what it's like to teach a whole continent to read versus run Lyft. Okay, how about that? That's David Richard, CEO of Lyft, off for just a really exciting Analyst Day. Very easy to understand deck. Lots of pages, but not a lot of words. Mad Money's back after the break.
There we go. Thank you, man.
Coming up, an earnings beat and a dip in the red. Is this icon under a snack attack? Stick with Cramer.
What do we do with the recession-proof packaged food stocks now that there are more and more signs of a slowdown? Sometimes it feels like Wall Street doesn't know what to do with the group. Consider the case of Campbell Soup. That's the house of iconic brands. You know them: Goldfish, Pepperidge Farm, Snyder's of Hanover, Prego, and many others. Yesterday morning, this company reported a modest top and bottom line beat, but they also cut their full-year organic sales growth forecast and lowered their full-year adjusted earnings per share outlook, blaming a, quote, discerning consumer, particularly at lower levels. At the same time, management had some positive commentary about the integration of newly acquired Sovos brands, which gave them that great Rao's positive sauce, among other brands. In response, stocks down only about 1.3% over the past 2 days. Hey, I think that's less than what you would get with a typical guidance cut, because it really wasn't a typical guidance cut. So where do we go from here? Let's dig deep with Mark Klaus, the president and CEO of Campbell Soup, to learn more about the quarter and what comes next. Mr. Klaus, welcome back to Mad Money.
Great to be back with you, Jim.
Okay, so first we got to get one thing really straight, Mark. Wall Street is so interested in just having cut forecasts, raise forecasts, beat forecasts. It was actually a far more nuanced story you told. I thought what you basically said, look, things are good. Got to be sure that that snacking keeps up. If not, maybe we don't do as well. And it got reflected as you think your forecast is going lower. That was not the case, was it?
Not really. No, I would tell you, Jim, there's a lot to like in the third quarter for Campbell's. There were three, I think, very important proof points that investors have been looking for that we were able to deliver in the quarter. The first is we want to continue to see sequential improvement in the business and having it fueled by volume, right? As pricing comes down as a tool, we want to see those volumes coming back. And in this particular quarter, we saw sequential improvement from Q2, actually stable volumes overall, and an improvement in our meals and beverages business, which was really a question that I think a lot of investors had. I think the second thing we needed to do in the quarter was show real progress on the margin side and show the earnings growth that we had projected for the back half of the year. And we saw that in Q3, double-digit growth on profit, double-digit growth on EPS, both very much in line and to some degree even ahead of expectations. And then finally, and arguably perhaps the most important in the quarter, was how is the integration of Sovos going? And I've done quite a few acquisitions over the years, and I have to say that really across the board, this integration is growing fantastically. The business grew 27% in the quarter. We were neutral on EPS. How many times have you seen a big scaled integration that had no dilution in the first quarter of the business? And when you put it together with Campbell's, on a pro forma basis, the total company would have grown collectively 2%, and our meals and beverage division would have been up 5%.
Right, well, that's the story.
That would have put us in the...
That's the story of over some very big numbers. Top. Well, I wish you, instead we all got bogged down in one line, okay? That you said the snack business is now facing some short-term pressure, especially among the lower middle-income consumers. Look, I think you tell, maybe it's your military background, I don't know. You tell it so as it is that I got sidetracked. I was focused on this billion-dollar sauce category, which to me makes a ton of sense because sauce is easy. And suddenly I say, well, wait a second, maybe it's Lance. I don't know, I'm a little worried here. You got us more worried than you should have.
Here's the reality. So snacking, first of all, let's set a little bit of context, right? Throughout this whole journey that has been filled with really almost unprecedented levels of inflation, the snacks business's level of resilience has been astounding, right? On a 3-year basis, we have grown that business at an 8% CAGR, right? I mean, well above historical levels.
Fantastic.
For food, but even above historical levels for snacking. And in particular, in this quarter, we were lapping a 12% growth from a year ago. Now, in fairness, the business was off 2% on top line for the quarter. That was a bit more than we had expected as we saw the recovery curve a little bit more, moving in a little bit faster way. But when I think about the role of snacking, and I think about what we have now built in this transformed portfolio, right? 50% of the business is snacks. I see no structural problem. I expect this to be outsized growth. And now we've added the best growth story in all of food with Sovos. And that changes the trajectory of our meals and beverage business, where even though I remain extremely bullish on soup, but even if you're not, it's now less than a quarter of the business as we've added this very, very high growth Sovos and Rao's business.
Okay, but all right. So I mentioned to the group that I asked some people whether they like Noosa, like yogurt, your yogurt. Yeah. Everybody loves it. In the quarter, it's obviously doing really well. Somehow that becomes non-core and has to go. I can see other businesses you have that are less core than that one. And why do you decide that something so good has to go?
Yeah, so it's a great business, and don't get me wrong at all, right? Noosa as a brand and the unique and the differentiation of the product is extraordinary. Yogurt and the temperature class of yogurt, the route to market, all of that is non-core to Campbell's. And look, if you look at the history of our company, I think one thing that we've learned a tough lesson on is making sure that we understand where our real strengths are. And as much as I love that brand, relative to what our core is and what we're really good at, Noosa is a great brand. Not like we're going to give it away. We're going to make sure that this is a really good option if we choose to go that route. But in the end, yogurt is part of the Campbell's business. It's just not core to where our strengths really reside.
That makes sense. I know, because delivery matters, putting it on the truck matters, not putting it on the truck. Okay, so now, in my hands, I have a Jason Kelce number 62 Chunky, and I have Rayo's, okay? Which is more popular in Philadelphia, the Kelce or the Rayo's?
Oh, man. Yeah, I don't think you can beat Jason Kelce in Philadelphia right now. And look, he's been a terrific partner of ours, as has Travis as well this year. And look, Chunky Soup continues to be, this brand that defies logic when you think about the world we're in today and just how popular that brand has been, how well it's done with younger consumers. And again, as we look forward, I continue to see soup playing an extremely important role. I know one of the areas you've talked a lot about is GLP-1 drugs and how will that change how consumers eat. And certain companies have announced products that are more specific to it. Here's what I can tell you we've learned, right? I don't see it in our numbers as a big factor today, but what we have learned is how do consumers eat as they're taking these drugs. And one of the main elements of it is this combination of easy to digest, nutritionally dense, great tasting. There could not be a better category than soup as it relates to how consumers do evolve some of their eating habits when they're on this drug or taking this medication.
Well, there we go. We finally have some food guy who's willing to say what it may impact. Thank you very much for all of your direction. Congratulations on Rayo's. Don't be so hard on yourself. That's Mark Klaus. He's president and CEO of Campbell's. By the way, about a 3.5% yield. Not shabby. This is what you buy in a slowdown. Mad Money's back after the break.
Coming up, the latest jewel in Warren Buffett's crown. Can this stock ensure a bull market for your portfolio? Stay tuned.
Right now, we have a raging bull market in insurance. So you don't hear much about it because talking about insurance, sometimes it puts people to sleep. But between strong pricing power and high interest rates, which allow the insurance companies to get a better return when they invest your premiums, the whole group is on fire. Take Chubb Limited, the diversified insurance provider that's best known for its big-time property and casualty insurance franchise, but there are many others. Here's a stock that's up almost 38% over the past year, yet even after this move, it still sells for just 12 times this year's earnings estimate? That's mystifying. Plus, last month, Chubb got a major vote of confidence when we learned that this stock is the mystery position that Warren Buffett's Berkshire Hathaway has been teasing about for the past couple of quarters. Now, the current price seems ridiculously low. So should you join Buffett with a position in Chubb? Let's take a closer look at Evan Greenberg. He's the chairman and CEO of Chubb, and for my money, one of the sharpest executives in the insurance industry. And, of course, he's also my insurer, Mr. Greenberg. Welcome back to Mad Money.
Jim, it's good to be with you.
Well, I've got to tell you, you hit it out of the park again and again, but there's nothing like Warren Buffett giving you the endorsement. And, of course, he has Geico, which isn't as big as your company, but is still huge. So what's it like? What was it like to know that the mystery buyer is buying you?
First of all, I know Warren, and I have an amazing regard for his capabilities. He may be the world's greatest investor of his time. And what a builder. What he has accomplished speaks for itself. And that he knows insurance. Over 40% of his business is insurance. And that he would choose to invest in Chubb and become a significant long-term shareholder is so gratifying and such a vote of confidence. We're honored.
Now, I would also have to believe, like Occidental, he can continue to buy. He doesn't have to tell you. He's allowed to buy all he wants.
Well, that's exactly right. And it would be better if he isn't telling me, because that's a disclosable event.
Absolutely. Now, I want to talk about your business. This is a halcyon time to be in your business. That doesn't necessarily mean everybody makes a lot of money. And what I want potential investors to know, you know how to underwrite. You know how to do it profitably. It's very clear from all your materials. Not everybody does. What's the difference between someone who knows how to write, who knows how to price, and the people who are just out of the league?
We're in the risk business. And in the risk business, it's about how you structure risk. First, how you conceptualize and understand it. Then, can you structure it and price it properly? And if you can do that, then you can assume it. The art and science of that is what they call underwriting. That is the soul of who we are. Every company that is successful, the wellhead of success is, first of all, to know who are you and what is the purpose for which you exist. Ours is to underwrite and to assume risk. And by the way, you assume it when you can be paid properly on a risk-adjusted basis for taking the risk. And if you can't, you shrink, you walk away. Very few. Everyone will say, oh, yes, I walk away when it isn't priced or structured right. But very few are willing to pay that price and shrink. We've proven that over 20 years. In any business where we fundamentally can't achieve the right return, we will walk away.
I think you can do that. One of the reasons why is because there's a perception in this country that I think now is true. When I was growing up, my father said, listen, one day maybe you'll be wealthy enough to be insured by Chubb. This is a 70-year continuum where people still say that. How did it happen that Chubb is the one that we always say pays? They pay, versus the others where they say, I hope you get paid.
You know, look, Chubb, let's just start with what is the company? We're a global insurer where 60% of our business is in the U.S., 40% is outside the United States. Our two biggest regions are North America and Asia. To me, the two regions of the world with the greatest potential for growth over the next 15 or 20 years, all industries, economically speaking, in a broad sense. In the United States, we're the largest commercial insurer of businesses of all sizes. We're the largest insurer of agriculture. We're the largest insurer, and this is what you mean and know us for, of affluent people, and we dominate in that business. It is the wellhead of our brand, and it's known for the quality of the product, the richness of the coverage, and the service we provide. The halo that business has provided has really been a halo across our businesses, and it speaks to our ethos and our culture. It's not about simply the letter of the policy. It's about the spirit of the coverage we sell, and to provide the spirit of that at claim time and at engineering time to our customers.
And that's why I am perfectly willing to pay, because I know it's premium. The same reason that I want a premium broker for my capital. But what I don't understand, right now, CPI, they keep saying insurance is something that's intractable that goes up. Well, look, if you're well off, you should pay. Your stuff is increased in value. You better pay. But why do you think insurance in general has gone up so much?
Loss costs. Yes, we've come off of a period of 20 years, just think of it generally, of low inflation. Low inflation, everything, and negative rates, negative real rates. We've been in a period of general inflation, and then there's inflation that's particular to insurance. So general inflation would be wages, would be supplies, parts and labor, all the rest. But what's particular to insurance, climate change on one hand. Climate change has created tremendous volatility, and it continues to evolve. And the concentrations of values in areas where the climate, the impact of the climate is greatest, continues to increase. Number two, litigation costs. Litigation in the United States is now 2.5% of GDP. The litigation industry is just that, a money-making industry, i.e. the trial bar. And they're very well organized. And now you have litigation funding as fuel on top of that. And they constantly perfect new theories of liability, and who pays for it? Corporate America, and in turn the consumer and the taxpayer. But litigation expense, insurers, we don't have the printing press. We intermediate money. We don't produce money. And so therefore, reflecting loss cost, when you think general inflation, when you think climate change, when you think litigation, that is driving the pricing of insurance.
And for those who disagree with that, you've got to read a shareholder letter, and you'll understand why it's a tax on you, okay? Before you make a political judgment, it's a tax on you. One thing, China, you have written passionately about the need to engage. It's also a tremendous opportunity for Chubb. You're a leader in this country in business with our relations with China. Give me the state of play and how you feel things could go right or wrong and what we can do about it.
You know, right now we have what I'll say is tactical stability. Both countries need the stability in the relationship. The U.S.-China relationship and the rivalry and the competition between the two colors all geopolitical events today. It is the one constant around the world. And you said it, two great powers, the two largest economies in the world, both nuclear armed, each wants to pursue its own vision of greatness, its own prosperity, its own sense of greatness for its people. We have to find a way to coexist. And it's only going to happen, that coexistence, where we can, because think, if it isn't coexistence, then it's the opposite of coexistence.
And that's why, again,
one of us doesn't exist. And what that means engagement.
I want everyone to read this, move my view about how we should approach with China, because it's rational. The most rational shareholder letter I have ever read, and very convincing. I want to thank Evan Greenberg, Chairman, CEO of Chubb Limited and Chubb Group. Thank you so much. Great.
Jim, thank you. Thanks for having me.
Yeah, money, right now.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. So we're wrapping up calls. Let me say this. Talk about myself. Jumping into the calls, but we can play this now. And then the lightning round is over. Are you ready, Ski Dad? Time for the lightning round. Cramer's myself with William in Massachusetts. William.
Booyah, Jim Cramer.
Excellent. How can I help you, William?
Jim, about last summer, I'm a club member. Last summer, we discussed on the show about Vertiv Holdings, and you gave me the green light, and I'm very happy. I want to get some more. What do you think?
Okay, so here's the deal with Vertiv, and as well with everybody else involved with data center. People decided, you know what, Justin's going to crack down on NVIDIA, and therefore this whole data center business is going to go bad. That's a one-day reaction. It's wrong. Buy more Vertiv. It was down 9. I think the stock's terrific. Let's go to Dave in Illinois. Dave.
Dr. Cramer, my mad vegetable gardening friend. Anything new and exciting in your 36 garden season?
I will tell you that the string beans came up yesterday, and they look real good. I'm not kidding. That's a very near-term report. Let's go to work.
Jim, I know it's Thursday, but I want to talk to you about Monday. This $11 billion software applications company specializes in workflow and sales management. It has outperformed the S&P so far this year. Jim, your thoughts on MNDY?
MNDY is really good. It's just I'm going to throw in HubSpot. I'll give Dave a twofer because Dave deserves that. I will tell you that enterprise software had kind of a resurgence today. They had a bit of bear market. It was led by Salesforce, but Monday's a very good company. You got a good call there. Let's go to Luana in New Mexico. Luana.
Yes, Cramer, thank you. With AI driving the market, I heard getting into the nuclear power sector is a smart buy at SMR, NuScale Power Corp. What's your thoughts?
It's a very good company, but we got to be very aware that the nuclear power industry is many, many years before we'll see anything coming from that company, and it's going to lose money for a very long time. I need you to know that because a lot of people are very hopeful about Nuke coming back, and I think it's still too early. Let's go to Michael in New York. Michael.
Good evening, Jim. This is Michael from Long Island.
Hey, how you doing, Michael?
I'm good. Thank you. I've been a club member for about 3 years. My wife and I watch your show every night.
Thank you.
I'm calling about a very successful cybersecurity stock that's had a great run, but it seems to have stalled over the past several months.
All right.
It's at its one-year resistance level and in the middle of its relative strength index.
Okay.
I'm talking about Palo Alto Networks, PAN-W.
All right, Palo Alto Networks. Well, I'll tell you, it's been a tough time. See, because CrowdStrike is doing better than Palo Alto. CrowdStrike didn't miss. Actually, CrowdStrike's never missed. And Palo Alto's had 3 straight quarters now where I'm worried. So I think you're right, and all I can tell you is I am concerned. All right, let's leave it at that. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
As we watch NVIDIA go from $2 trillion in market cap a few months ago to $3 trillion yesterday, I figured that it was only a matter of time before the Biden administration's antitrust regulators went to work investigating the company for anti-competitive behavior. Sure enough, we heard late last night federal regulators have reached a deal that allows them to proceed with antitrust investigations into the dominant roles that Microsoft, OpenAI, and NVIDIA play in the artificial intelligence industry. Thank you, New York Times. The Justice Department will go after NVIDIA. The FTC will handle Microsoft and OpenAI. Terrific. Great to hear that antitrust and the FTC are on the case. Protect us from any company with massive market capitalization, even if it hasn't done anything wrong. It's been a long time since I studied antitrust at Harvard Law under the greatest antitrust scholar of all time, Phil Arita, and I actually took the class seriously, believe it or not. But I can tell you that antitrust doctrine has been stood on its head by these two agencies. We want the government to promote fair competition and prevent monopolies that could harm consumers, harm you, businesses. We want innovation. We want competition. We want what's a good deal for the people of the United States. But that's not the doctrine of the Biden administration, at least not that I see it. To me, the doctrine is pretty clear. If it's big, it's bad. Whether it's Apple with its App Store dominance or Google with its online advertising dominance or Amazon with its retail dominance to approximate their terminology, you know that there's this overwhelming sense of punitive action simply because these companies have achieved just tremendous success. Now NVIDIA joins that club of pariahs because it may have too much control over AI. I say that's what happens when you invent the chips that make AI possible. Let me put my cards on the table. For the longest time, our country dominated just two industries, soft drinks and movies. And that was it. Periodically, we might develop a drug that other people might think, oh, gee, America did something. But for the most part, I think when you grew up in my era, America felt like a pitiful, helpless giant that the rest of the world was running circles around. But then Apple and Microsoft came along, followed by Amazon, Alphabet, NVIDIA. All of these tech companies are part of what I call the scrum. Great businesses going at each other to see who is the best in the world. These days, America leads in everything tech, not just in carbonated water and syrup and movies. Plus, in each case, these mega-cap tech companies have done their best to straddle the line between making their products superior and still getting a healthy return on capital. I phrase it like that because NVIDIA is charging a fortune for Blackwell chips. I get that. That's the latest version they have. But it also spent billions designing and manufacturing them. They deserve they deserve some return on that. I know greatness doesn't figure into these lawyers' thinking, but if we dig down and we find amazing levels of customer satisfaction and even wonderment, I don't want to be too simplistic, but Apple looks to be in trouble. Why? Because it makes the best phone in the world with the best ecosystem. Amazon's been targeted because of superior prices and customer service. NVIDIA's in the crosshairs because it spent fortunes developing a product that most people never even thought about until ChatGPT. It's changing the world. Google, it's supposed to dominate online advertising, according to Justice. But, geez, look at what Trade Desk has done. Factor that in. This is crazy. I say enough with the jackboots. Enough with going after the biggest businesses simply because they're big, even when they're the best at what they do, and they are the envy of the entire world. It's not like they're ripping off their customers. Listen to NVIDIA's customers. They're all thrilled. It's simply that they have no competition because their products and services are so superior. I don't think they should be punished for that. If anything, they should be rewarded. If we let the regulators punish companies like NVIDIA for innovating, our country won't be able to maintain its dominance in tech for very long. In the end, we need to go back to a simpler doctrine. Was there rapacious, monopolistic behavior that destroyed competition and hurt the consumer? If not, then just let them keep helping us keep prices down and make our country stronger than it could ever possibly be without them. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.